Was that a new intro?
I mean, it sounded there was very crispy guitar, nice crispy guitar music.
No,
but maybe
the music.
It might be the drugs talking.
The music was the same. It looked like the video was different. Anyway, I'm Tom Sosnoff. He's Dylan Radigan. This is Truth or Skepticism. Thank you for joining us this week. How are you, Mr. Radigan?
I'm good. I'm very good. I'm just a bit perplexed because I think that, the classical wall of worry has an abundance of objects upon which you can hang. And I feel like the stock market should be performing worse than it is. And I feel like oil should be more expensive than it is. I feel like the bond market is reflecting more risk, but that the stock market is holding on to the dream. And I feel like it's a little bit... Well, I mean, I don't know if it's even perplexing because it's so apparent that you have sort of NVIDIA, Meta, and Tesla, the big three. All three are triples this year. Like they're carrying most of the water.
Yeah.
And so it's basically living in parallel worlds.
So
I'm questioning the efficiency of maybe not the market, but the index's ability to reflect the market.
No,
if they're so distorted by the big three that they create the appearance of performance that may be lacking overall.
So you're not really confused. You're not confused by the efficiency of the market. You're confused by your interpretation.
I'm not saying that. I'm assuming the market's efficient, but I'm saying that the market data evaluation mechanisms or KPIs are not accurately transmitting the performance of the market in a way that would then reflect in headline numbers, the reduction in equity value relative to perceived costs of future cash flow.
So let me say this in lay terms. You're upset because a couple of stocks have carried this market and the majority of the market is lower, not higher.
Yeah, it's a joke. What is this, a joke? We're just walking around saying things. It's three companies. Okay, if I pull Meta, Tesla, I'll forget the rest of the whole shebang. Meta, Tesla, NVIDIA. Those three. Everybody else is out. Amazon, go away. Everybody, bye-bye. And you take those three, and there's nothing. There's nothing. And the bond market's like, yeah, there's nothing. Gold's like, yeah, there's nothing. Like there's a list of issues here. Government in the U.S. I don't have to go out of the bad news bears, but it's not pretty. But the stock market appears, I think, more resilient than actually it is, I guess is what I'm asserting.
Sure. And if Bartman didn't get in the way, the Cubs would have won the World Series that year. And if this thing or that thing didn't happen.
Okay. You want to play smart ass?
I mean,
well, then that's a case for indexing. Because you don't know if the market is going to be so asymmetrical in its performance. Your only chance is to buy the basket, the biggest basket you can get your hands on, and hope somewhere in that pile of rocks is a diamond or three. I mean, that's what this is.
Not really. I mean, to me, what you're just explaining now is the old school way of thinking, which is what I've worked so hard at Tasty to remove from everybody's, from the way everybody essentially describes the markets.
Like black mold in the basement. It's the bane of your existence.
Yeah, like that's it. I mean, the fact that you can't figure out why the bond market's lower, the stock market's higher, and crude oil is not higher right now.
I didn't say I can't figure it out. I never said that.
You said it. It didn't make sense.
I said the data reflects a distorted perception that makes it appear unreconcilable. And that's because the data, like the way we measure GDP is wrong. The way the S&P 500 measures stock market performance is wrong. The way the NASDAQ 100 measures and reflects stock market is wrong.
So you think it would be better... You think the more important thing would be to change the way we measure this stuff?
Yes, I think this is a call for. I'm calling for a rule change on the game here.
You know what I love about that? That's
what I'm doing, man.
That's so
I'm calling
basic.
For a rule change.
So we're going to call for a rule change rather than just not do the smart thing, which is just change the game. See, you don't need a rule change. What we have now is the perfect amount of efficiency combined with the perfect amount of, randomness and just, odd events occur. That
uncertainty they call it.
Uncertainty, or just things that just don't make sense to everybody. And that's the beauty of markets. That's the beauty of the efficiency around markets and markets in general. And what people don't understand is, okay, let me give you the other side to this. How have we been able to, because all the traditional correlations, the inverse correlations, the standard correlations, everything's out of whack. Like, this doesn't make any sense. Crude oil here with this thing here, with bonds down here, with NASDAQ here. None of it makes sense to anybody. But yet, the efficiency
with no whack.
But yet, the efficiency of the market is the best it's ever been, meaning the efficiency with respect to price discovery, order execution, everything else is the best it's ever been. So is the problem then that the old schoolers, like the Dylan Radigans of the world, trying to get an answer to the question, are confused, or that the new schoolers just haven't taken fully over yet, and the game hasn't changed from a public perception side? In other words, you can't have.
You're talking gibberish. You're just talking.
No. Stop.
You're just running. It's called flood the zone. Just words.
No. If the marketplace, if the actual tradable markets are more efficient than they've ever been in history, which is the case today, regardless of what you see going on in the market today. Uncontested is that the level of efficiency, you can fill any order basically anywhere, one tick around mid-price. We've never seen this kind of efficiency before. If you have this kind of efficiency without the ability to explain why we are, where we are, what's trading, where it's trading, and everything else, that means that one of two things that something's going on. On the one hand,
that's what it means. All right.
We have this incredible efficiency, which means that, yes, the people that get this have figured it out. On the other hand, we have this whole group walking around in a daze saying, this doesn't make sense. Like, this goes up, this should be down, all this stuff. And what I love about this is the group that actually makes that is the counterparty to all the trades and makes all the markets, has found this area, this ability to be within a fraction of a penny across the board efficiency in every underlying product. And yet there's some fundamental old school group walking around, this doesn't make any sense. I don't get it.
You just want to make fun of people today. Now you're just having fun.
So my whole point is,
you're using me as an avatar,
but this is
you're using me as an avatar for an entire social group.
This is the whole reason we created Tasty, because we said this old school group that's out there trying to figure out, this old school, fundamental, technical, news-based group that's trying to figure out, well, the Fed's meeting this week, what does that mean? And there's a war here, and there's a crisis here, and there's a vote here, and there's this, all this garbage, all this crap. Which,
what do you mean? But I mean, the actual bond market moved at the actual time that the actual economic data was released, showing stronger spending than was previously known. So that was new information about the future value of forward cash flow from the enterprises that constitute the publicly traded entities that constitute both the debt and equity markets of the world's largest and most liquid capital market. And a base decision is being made to adjust the basic cost of capital for that entire enterprise based on actual information that may or may not be correct, by the way. But when that information is introduced into the environment, much as it will be with earnings and earnings guidance and blah, 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 blah. And so you can walk around like Mr. Cool Guy, Mr. Rock and Roll, Mr. Howard Stern with your beret on the floor, Mr. Trader, and be like, oh, the old guys are like, oh, they want to know who met with what the Federal Reserve say, like that means anything.
Right.
And that's a good time for you and the boys. You make fun of the old men and you get yourself a company. But at the end of the day, the market still reflects, even if my interpretation or the old man's interpretation of the information is not useless for whatever reason, that the market by definition reflects a worldview. because the world impacts the earnings and value of the income and debt service of these companies.
Yeah, I disagree, but I'm trying to be nice.
Fact.
I'm trying to be nice, but
so what do you believe the market reflects if it doesn't reflect the perceived future value of the enterprise?
I don't know that the market is reflecting anything other than what the perception of what people think is happening. So in other words, the market is basically just the money flow tell, and the market is just representing, wherever whatever, where money is flowing. And that's essentially, the market is just a representation of order flow. It's this massive.
But order flow originates from some belief.
So that's what the market represents. Now the key is not about what the market represents, but how do we address that? How do we trade that? How do we take advantage of that? Now the counterparty firms, the high frequency firms, have figured out how to take advantage of it. It's just their job is scale. And they figured out that the tighter they make the markets, the more scale they have. What we haven't figured out yet is on the trading side, how to take advantage of those tighter markets. And that's what we're trying to, that's the process right now that's taking place, is the conversion or the transition from.
Okay. So let's walk down this path a little bit. So let's assume that everything's tighter. The instrument is strung tighter than ever. And whatever, approaching zero in terms of its probability of accuracy.
Okay.
In theory, that would increase the value of information because it's more new information. Theoretically, is more. If I don't have the inefficiencies of commission and scarcity and other distortions, and then I'm really more efficiently tied to what is inflation? What is the war? What is the car sale? What are car sales? What are earnings? Who is the CEO? The never-ending questions of the old men. And you're saying that line of information is also not relevant. So you're saying I've got a really tight place.
What I'm saying is that the one half of all the order flow has converted to strictly a facilitation mechanism for the other half of the order flow. The other half of the order flow has not converted yet to understanding that their purpose is more about strategy than it is about guessing what's going to be right. So we're still playing a tug of war on one half of flow, but we've mastered the other half, which has gotten down to capital efficiency. Because you started the conversation off by talking about, efficient markets. And so I'm trying to get back to explaining, why we have efficient markets. I mean, the fact that we can't explain why oil is $87, when you said it should be more, and I think it should be less. But the fact that I think it should be less, the fact you think it should be more, doesn't mean anything. What's really important about oil is that it's trading for 87, as we sit here and talk, it's trading for 87.24, and the market is 100 contracts wide, 1 penny wide. And that's on the futures.
100 contracts deep, yeah.
100 contracts on each side, 1 penny wide. That's the important thing. And the fact that it can be 100 contracts wide, 1 penny, 100 contracts up, 1 penny wide, is what allows anybody that wants to do anything with the underlying and or the options and or any of the derivatives, the ability to do anything they want to do, is what's fascinating about where we are today. See, what nobody in the world understands about market structure and finance, at least I don't think, is everybody still thinks that everybody is making markets and trading based on what something's doing. They're not. They're making markets based on their ability to take advantage of scale now, which is all it is, which is a trend that is irreversible. See, I give these talks all the time about, where is this industry going? And years ago, the argument was, well, especially after like the crash of 1987 and mini crash and all these movements in the 90s, the answer was always like after a big kind of binary event or a big happening, whatever it was, oh my God, everybody's going to leave the markets and nobody's going to come back and play, all this kind of stuff, because everybody's wrong, everybody got beat up, everybody lost all their money, whatever it is. And the reality is that that's never going to happen because of the efficiency that we have now. It's never going to go the other way, because all we've done is get tighter and tighter markets with more and more extraordinary
but
events.
If you look at, when you just look at the issue of a few names driving the market, for just to come back to ground level here.
Okay.
So we'll say that the QQQ is an efficient representation of the level of that index, because of the 100 names in that index, there's such outperformance from a few of those names, which is typical with growth stocks, that you end up at this level X, Y,
I'll give you
Z1.
that. Sure.
But at the same time, it's not just those three. Like, those three stocks are the three best performing stocks in the S&P 500, and the Dow, and I mean, it sort of gets into the whole, the measurement apparatus.
Yeah.
Like the bond market, I guess my point is this: the bond market reflects material change in expectations in its behavior over the last few months.
Okay.
But I feel like the stock market does not.
That means absolutely nothing other than that's Dylan Radigan telling you what he feels.
No, that's saying that the relative level of the S&P 500 in terms of its overall movement relative to the movement of the bond market is less. So yeah, that is me telling you what I feel. But that's also a discussion which I guess you view as pointless, which is, why is the increased rate environment not more consequential to the equity indices? And your answer is, I don't care, which I understand that, but I just question whether it is efficient.
Yeah, I know your favorite baseball team leads the majors in home runs in 2023, but the reality is that 3 hitters on that team have hit 50 home runs. So your argument there is that team really isn't hitting more home runs than they usually do. Just 3 players have hit more home runs than they usually do.
Historically, I mean, these are
I understand, but that to me, you can't eliminate those 3 players to get back to what you feel should be the average. So it's the same thing in the stock market. If there's 3 stocks or 5 stocks, this year it's, let's say, 7 to 10 stocks that have grossly outperformed, from Netflix to Microsoft to Meta to like you said.
Well, Meta, Tesla, Nvidia have all at least tripled at this point.
Nvidia, AMD, all these stocks. If these stocks had not done what they've done, then the stock market would be significantly lower. And there's tons of stocks that are trading at or near their 52-week lows. So the stock market, by definition, is a distortion from the numbers that they print, like saying that, hey, the market's up X amount. But the reality, like I just said, is that it is what it is. That's how the game's played every single year. And what happens next year when your 7 NASDAQ stocks that were up huge this year are all down on the year, and the broad market's higher. Right. And then you're going to say, but the broad market's actually lower this year. We're going to say no, but 80% of the stocks are higher.
I'm going to say it's an argument for indexing.
What's the argument for indexing?
Because I don't know which of those 3 or 7. I have no idea which of those out of the 500 names. I don't know which 1 to 10 are going to be the crazy ball.
Yeah, but so
my only choice is to buy the index and let the future reveal the crazy ball when it happens.
But if you buy the index next year, you might lose money on that index.
I mean, listen, I might lose money all, but that investment comes with the risk of losing money.
I understand. There's never an argument in my mind, there is absolutely never an argument for indexing unless you believe that the market has more potential to outperform. And you have to believe this. It doesn't mean you have to know that this is happening. But the only time you ever index is if you believe the market has the potential for gains that are a significant multiple of risk-free rates, and you're willing to take that risk. That's the only time you ever index.
And I would say the other time that you index is when there's a high probability that some of the names in the index are going to double, triple, or quadruple in value, but you have no idea which ones they are.
That's a ridiculous statement to make because how would you ever know that some of the names in the index?
Because every year a few names break out. So
then why wouldn't you buy the index every year?
That's the question at hand, isn't it?
It's not to me. It's your question. It's not my question. Last year you would have lost money. This year, because this year you would have made a little money. But that's your question.
Well, let me do this a different way instead of you just being ridiculous, because you're on drugs today. Which is when you have the performance. So how do you exploit these concentrated performance of names like those like we have in the tech sector right now?
I don't know if you could exploit them. I think you exploit them through trading those names. I don't think you can. I think you have to have positions on in those names because they are the most liquid underlyings and they are the most tradable underlyings. But I don't think you can exploit them directionally.
Meaning you can only exploit them relative to options buying and selling as it relates to implied volatility, expansion, and contraction. Because it's a liquid platform, basically.
That'd be my argument. Yes.
Mm-hmm. Where do you see extreme anywhere right now in this sort of moment?
I do see extreme. I see extreme in the bond market for sure.
As a buyer.
That's right.
Both long and short end? I mean, how do you have an opinion on why the bond's behaving the way that it's behaving for something that generally, it's showed a lot of activity relative to recent years?
I mean, my argument, I do have a thought on it. My argument is the bond market is doing what it's doing because it spent so many years going to an extreme in the other direction. It's just normalizing.
Like it's something that was like it's like somebody gave it an anesthetic and put it to sleep for a few years with the 0%.
Yeah, exactly.
And it's just waking up right now. It's like, oof. Yeah, and there's money for bank deposits, 5% if you just keep it in the bank. It's a whole different world. And if you want to borrow money, it's a real overhead.
The market is waking up. It's exactly right. And it's going to be different now for a long time to come. And, if you missed it, you missed it. And there'll be other markets that have a similar kind of tape action. But this has been an extraordinary move. And maybe.
So you feel like there's more opportunity than usual in the bond market as a result of the liveliness?
Exactly. I do.
And you see that in one way or the other? What short end, long end, spread?
I see it. Well, both on the yield curve and also on the. I also see it, on just being long bonds here, just as an opportunity, a pot odds opportunity. But I also see other spots around the market. I mean, there's a lot of oversold stocks in the growth sector that have gotten just crushed, and I think that a lot of them are really interesting as well.
For instance?
Just, a lot of names, some of the names that I talk about all the time in the tech sector or the growth sector, like DocuSign and Square and Chewy and Baba. Those are just some names that I have long positions in.
You're right. And what is it about this environment that leads you to feel opportunistic rather than anxious in the face of, there's no Speaker of the House. We got a holy war. We got a Ukrainian war. I got, whatever.
Well,
the list of things, man. I can go on and on. It's terrible.
Volatility is 19.5, so that gives me a lot of optimism because that's above the historical norm. So that's obviously something that gives us optimism. I mean, volumes are high, markets are good. I'm optimistic because there's things to do. I get very depressed if there's nothing to do. That's when I'm not optimistic. I will always be optimistic as long as there's crazy movement. That movement creates opportunity for me, not price.
But you see the sort of, I'll call it the swelling, the inflammation, the elevated activity rate, the elevated volatility as healthy right now, not as alarm.
No, it's absolutely healthy. There's no alarm. The alarm, if anything, is that there's no alarm. The alarm, if anything, is that there's an extraordinary amount of complacency out there. But I kind of think that's the new norm.
Which is the blasé generation.
Yeah, I think
aliens, no problem. Like I can run anything at you.
I think it is a blasé generation, and I do think it's I think it's kind of like a boring generation. Yep. Huh?
We'll say low reactivity. A low reactivity.
I think it's a boring generation.
So you.
Yeah, I do think
Which you actually think makes markets better.
Who do I think makes markets better?
No. I'm saying you think a boring generation makes markets better.
Well, I think it's a boring generation. I think that this generation does make good markets because they've stepped into a really good situation where they understand that they're making markets based on not based on know-how, but based on scale.
Mm-hmm. Which is an easier game, you're saying, overall.
It's an easier game to understand. It's an easier game to play. It's a game that they fully understand it when they enter it, because it's just a game.
Mm-hmm. And is there a role for AI in the bridge there, in the implementation of the position, even if the position itself is human directed, that whether it's a calendar spread or a call spread or a put spread or the configuration of the trade itself is aided by AI? Do you give that any stock?
It's a really tough one for me because no, I don't give it any stock. I think AI at this point, with respect to efficient markets, is very inefficient and overrated. I'm sure there's things that AI can do and will be able to do communication-wise and also kind of warning-wise. But AI is most successful where there is an ARB, and I don't see an ARB in this market.
So you don't see a difference between buying the TLT, buying bond options, selling put spreads on the TLT? I'm just using the bond as an example. I mean, obviously there's a difference in capital efficiency and capital risk and all those things, but it's all the same sentiment, right?
Yeah, same
and
sentiment.
You don't think there's a role for an analytic or an AI enhanced analytic to lay out odds on something like that?
There's probably a role for that. I think so. There might be. I don't think it's a do or die. I don't think you're going to get anything that's not right in front of you.
You don't think it's an essential service, and you don't think it's a meaningful difference in performance?
No.
What do you think is the most meaningful? Like, what are your first principles for performance in terms of influence? It's a question I've never asked you in a billion years, but that's an interesting question. That's a good question that I just asked you. First principles for performance. Size.
Yeah, I mean
liquidity. But that's boring. We've been through
those
that.
Are boring, but those, size.
That's like prerequisites. That's like your driver's license.
Yeah, size, liquidity, know-how, that kind of stuff.
Is it a good night's sleep? Is there a special spinach?
No. I think it's
just, you look at a spinning disc and meditate for 10 minutes before.
I think size, liquidity, duration, and those three win every time.
Yeah, but it's cheap. That's cheap wine for the masses. We want the real secrets here on Truth or Skepticism.
I know that is cheap wine for the masses. I agree.
We know. Anyway, that's an interesting question to reflect on in terms of those first principles. Because, once you get through the initial part, I guess, because what I'm getting at is, and also because I've been doing overtime almost every day with Chris and Ilya at 4:30 every day, and they're much more of they just love to dig through the sand looking for specks of gold, on the side, like what do they call them? Panhandlers. When they sit on the side of the road with a pan, they start sifting through the dirt. They're two guys hanging out. They talk and get a little sunburn. They're like, I think this is a thing right here. I'll tell you. looks, this is a, whatever it is. But that discussion has led to more constant and enhanced awareness of the need to transition between whatever you think your extreme is, or whatever your point of view is, and its implementation and its exit. Sell half. I mean, and I know that there's sort of all the tasty trade guidelines. I'm not going to ask you to rewrite all that right now, but I just wonder whether AI can help both on entry and exit in terms of structure and also exiting. Maybe I'm lazy. So I'm like,
I don't know the answer. I know the answer. I think the answer is no, but I don't know.
And you think the answer is no because you're skeptical of AI? Why are you so fundamental in your skepticism?
No, I'm not skeptical. I just think there's too many things you have to program in. I don't think it's that easy.
You're saying that each situation is its own situation. And so whatever set of rules you try to create are not going to be useful because they're not consistent from one situation to the next.
Yeah. I mean, like, the person,
once you get above liquidity size and like, once you clear the first hurdle, there's really no rules.
Yeah, the person puts in an order, and next thing you know, no, I can't do it.
Because it's second, because it exists. That's why you're saying AI can't do this, is because the information field is unknowable until it exists.
Yeah, and
you
AI
can't know the information field before the information field has already manifested itself. Basically.
And AI is most valuable with just giving us a review. Like giving us a tour, whatever
editorial.
It is. Yeah.
Welcome aboard. See you later.
Yeah.
Nice to see you. Check out the sneakers. Check out the hamburgers.
And don't let the door hit you on the ass on the way out.
Check out the toast. We'll see you later. Thank you, AI. Here's a Coke.
Thank you and good night. I don't feel threatened by AI at all.
Yeah, I don't even say that. I don't see it as a threat at all. I was just wondering whether it was to assist in the implementation phase once an opinion has been generated. And the question is, are you, but I don't see it as a I think the reason people do this is because it is really pleasurable and enjoyable for them. Enough people make enough money. But I think people do this for more reasons than our P&L. I think it's a personality type that's a self-directed trader.
Some of it is. I mean, I know that there's been times when, I've done things 0 DT, 1 DT, where it's taken pretty hard, because either I did something too big or I did something, didn't give myself a chance to work my way out of it or something. Yeah. But in general, yeah.
What's your opinion on selling half?
I don't like buying half and then buying more later. Selling half I can live with.
Is it part of your day-to-day?
No.
So you're 100% allocated, or a 0% is your typical?
I'm 100% allocated. I'm 100% allocated.
And why was the sell half question so burdensome for you that you had to do a giant exhale and collect yourself?
I don't sell half. I just don't do it. I don't do it.
Why not?
I don't know.
Does Tony?
No.
Did anyone on the floor?
Yes.
Okay.
Yes, but they were all losers.
Really?
Yes.
So sell half is a red flag for a loser.
Yes, because you have trouble focusing on the next trade when you still have half the other trade left.
And so what about being wrong about timing?
Wrong about timing. Oof.
So I'm long Tesla puts and it goes my way and I sell it. But I'm selling too soon, or whatever, Coinbase or whatever. It could be anything at any time on a run.
Really,
and selling too soon.
Really tough. I think we're all guilty of selling too soon. Everybody.
I would think, but you don't find selling half to be or selling a portion to be.
Selling too soon. The default is always to opt to sell too soon. The default is always to opt to sell early. There's nothing wrong with that. The default when you have something in your possession to sell it to the person whose possession it is, or to share it with that person for whatever it is, the chances of you forgetting that behind are not very good. But if you do, it's not about, it's like you actually forgot about it. It's not like you intentionally did something.
And that is because your confidence in your viewfinder's ability to always find the next opportunity is higher than the odds of anything happening on the tail of something you've closed.
Exactly.
So this is it's an egoic statement that says, no. My ability to find new deals is better than whatever the odds are of the mental and capital requirements of tailing this piece of junk.
Yeah. Well, you've already pissed me off because I'm already there. So yeah. 100%. But listen, we're getting too far down a rabbit hole here. But
no, but I think it's because at the fun, it's not. But I would say this is not the fun. We're nowhere near a rabbit hole. I would say we're in the Coliseum on the floor, because this is the basic instinct of the entire industry, which is you don't know. So index and buy and sell incrementally both ways.
The problem with indexing,
and the trader mentality, that is, I have such a good viewfinder and thesis that I just need to chip wood on a regular basis, and I don't care what happens outside of that.
The problem with indexing is that it's almost impossible to time getting in or time getting out. So it's just to me, it's just dead money. I hate dead money.
Okay. But also you don't even like partial incremental. I guess you manage for size on trade size.
Yeah.
And for trade exit, you're saying have more confidence in your ability to find a better trade.
Yeah.
Than you do in the need to play the lottery ticket on the back half of whatever just worked.
Exactly.
And if you're not confident enough, then you need to work on your viewfinder.
Yeah, exactly.
A reasonable position. It's very fundamentalist.
I got it. I got it. I got it. Anyway, let's see. Where else were we going with this? Because I don't want to go. feel like we're straying. Let's see what time it is. It's 1:40.
Well, no. I mean, the obvious thing is the bond extreme. I mean, and just in terms of the world today. I mean, but you could have said that yesterday, right? Like the bonds been doing this for a minute.
Yeah. You could say it any day. Basically, the bonds are back at. They made a new low today, or tied for a new low today. They've rallied back about a point off their lows, so it's had a nice little rally. I think the bonds. I think there's two plays in the market that are going to normalize next year that are going to be incredibly valuable for every listener. One is to be leaning long in the bonds, because I think the bonds are, on the verge of blowing the doors off to the upside just as a trade. And also, I think that's the main thing. But I also
what is blowing the doors off in your mind? One standard deviation?
Yeah.
More than one standard deviation?
Yeah, one standard deviation would be fine. Two standard deviations, that kind of thing. Two. Let's say two. Let's see. Let's just see for a quick second. Two standard deviations. Two standard deviations by November will take us up to, let's just call it little over 120, 121 and change. We're at, we're at 109. It's 10-point move. It's huge. It's 10%. Little.
10% is sort of in the Springer with a little whatever.
And the other one there's actually a couple others I like. I like the U.S. dollar tremendously here. I think the
as
dollar,
a short.
As a long. I'm sorry, the U.S. dollar is a short. Yeah.
I would love it if you were like the dollar is going up from here.
No. I like the U.S. dollar as a short. I like all the foreign currencies as a buy. And the other thing I think next year is a given is that your group of tech stocks that led the market this year are going to be sharply lower.
Next year.
Next year.
Next year's a bad year for Tesla, Nvidia, Meta,
and a bad year and a good year for bonds, and a bad year for high frequency stocks, a good year for S&P stocks.
Short tech, long bond.
Yep. Short tech, long small cap, short tech, short bonds, long small cap, and long tech stocks, or
long bonds.
Yeah, long bonds. Yep.
We got
so many things. What I say? Short dollar, long bonds,
short
tech, long Russell.
Exactly.
Yeah. Long small caps.
Well, the bond situation seems to be. What about there seems to be a bit of a public consensus on that bond position. Does that make you nervous?
No. So, the public doesn't make me anything. The public's always wrong.
But what if you're with the public?
I'm not. I never am.
Even if you have the same position.
That's right. I'm never with the public. I'm a Swiftie now, though, so I'm kind of with the public in that regard. But other than that, I'm fine.
And what if she breaks up with the Kansas City boyfriend? You're still with her?
I don't know.
I was talking to a 10-year-old niece of mine out in California. I was trying because I'm a Swiftie. I'm on the Swiftie. I'm on the team with you. Yeah. I'd run her for president.
Yeah, sure. I'll run her for president too.
In a heartbeat. And so I was really selling the Swift, and I had a 10-year-old girl tell me she thought that from a presidential standpoint, she thought that Taylor was a bit too emotional and maybe too reactive, maybe volatility. You might want a cooler headed executive, she suggested.
Oh, your buddy! I saw your buddy's running for president.
Who?
Cenk.
Oh, is he running for president?
He's gonna run in the Democratic primary.
I mean, that's a stunt. I mean, come on. I mean, that's like a marketing expense. He's in the media business. I mean, with all due respect,
love that. I mean, guy.
More interesting. If you want to do politics, you want to open Pandora's box. We avoided it for the.
No. I don't want to do politics, but I want to say I love that guy.
Oh yeah, I love that guy.
I love that guy.
He's a legitimate Turk.
He is. I would vote for him for president in 1 second. I love that guy.
Well, one of the highlights of my cable news career was he was doing like a 1 minute editorial comment on my MSNBC show. Somebody like, Tom Sosnoff is here to tell you why the regulators are a bunch of jackoffs. Yeah. And Tom's like, I'll tell you this rule. So Cenk was coming on to do stuff like that. I forget what the topic was. Yeah. And his bottom line was that you had to get some people off. Like he had to fire some people. Like he's like, the only way to solve this is some group of people, whoever they were, they need to be fired. Yeah. And I was like, well, Cenk, how do you fire those people? How would you go about that? And he's like, you just walk up behind him real big and just yell, get. And he started like he was chasing a pig.
I have the presidential ballot for 2024. I want our boy Cenk. And
we're on Team Uyghur.
Yes. And then I want him to go against Lauren Boebert. Because
you want a Lauren Cenk finale?
She's my favorite. He's my favorite. I want those two going. Maybe
we should co-host fundraisers. We could do joint fundraisers. Yeah. Dylan and Tom's political fundraising parties.
They are completely the opposite sides of the spectrum. They're not even.
We're raising money for Cenk Uyghur and Lauren Boebert. Come on over to the park. They don't agree
on one single thing. It would be the greatest thing ever.
They've never met. They don't even know each other. We are the tie that binds.
It would be the greatest thing ever. It would change politics in this country forever. It would be great.
We raise it as a super PAC, so we control the money, so they don't even get the money. And then when they both lose, because I think she's actually probably going to lose, we use all the money to back Taylor Swift for president. We raise money on the back of Cenk and Lauren. Then they're going to lose, but we'll have a war chest. And then we pivot and then really supercharge a Taylor Swift for president straight into next October. This is a good political strategy.
Does she want to run for president?
I don't think we get. I think that when the country, when you're called to serve, sir, it's not.
Well,
not
that one guy won. Why can't I think of the comedian? Who was the comedian that won?
Zelensky.
No, not Zelensky. Before Zelensky, the other, I forgot which. Zelensky was something, but was he?
No, Zelensky was a sitcom star. He was a big star. They loved him. He was beloved in Moscow as the Chappelle of Moscow, 20 years ago.
Yeah, but there was another guy that won in some country. I can't remember if it was. I don't remember where it was. Somewhere in South America, but he won. He was
What about Deion Sanders? I'd run him too. I'd run Deion versus Taylor.
Sure, bring on Deion.
Deion's a great presidential candidate. Are you kidding me? He's a good role model for young men.
I'm all for him bringing Deion.
Better than Andrew Tate and these other fools. He's listen, help work it out. Yeah. Look good, feel good, be good. All this stuff.
I'm all for Deion. Yeah, bring him.
Taylor and Deion are we raise money for Boebert, Jank, Taylor, and Deion. 4-pack.
I would do that.
That's a fun theme for the party. And then you have Deion stuff.
I would do that.
It could be a fun party.
I would do that so much better.
2024 fundraising for these 4 people.
All right, we're off the rails. I'm Tom Sosnoff. He's Dylan Radigan. Truth or Skepticism. We'll see you next Wednesday. Thanks so much.
All right, see you soon.